Welcome to This Explainer. Today, we're tearing right into a really fascinating corporate transformation. We are looking at World Kinect Corporation, a company that just delivered an absolute monster of a Q1 2026 earnings beat. But honestly, beyond those flashy numbers, what is truly captivating here is the broader strategic shift taking place behind the scenes. We're talking about a legacy, traditional fuel reseller that is aggressively mutating into a highly integrated global energy manager. It's a massive pivot, and we're going to break down exactly how they're pulling it off. Okay, let's map out exactly where we're headed. We'll start with that Q1 earnings breakdown. Check out what's happening under the hood in their three core segments, map out this massive green energy pivot, size up the competition, check the financial health, and finally, weigh the real strategic risks. Let's dive in. Right off the bat, you have to look at this number, a massive 56% year-over-year jump in adjusted diluted earnings per share, hitting 75 cents for the first quarter of 2026. This isn't just a slight beat, it's a huge catalyst. It proves that all their recent, painful restructuring efforts are actually gaining serious traction, yanking the company back to solid profitability compared to the losses we saw sitting right here this time last year. All right, Section 1, Q1 2026 earnings breakdown, and how they are returning to profitability. Now, here is where it gets really interesting. Just look at the disconnect between revenue and profit growth. Total revenue came in at about $9.7 billion. Now, that's only a 2% bump from the previous year. Pretty flat, right? But look at the gross profit line. Bam! It surged 18% to $271.2 million. Adjusted EBITDA also climbed 18% to $94.4 million, and net income swung from a $21.1 million loss last year to a positive $26.2 million. This is the definition of operational efficiency. They are aggressively widening their margins and squeezing significantly more profit out of roughly the exact same amount of revenue. But it's not just the ledger doing the talking. Alongside these incredibly strong financials, management announced a really smart, streamlined branding pivot. While the corporate legal entity stays World Kinect, they're transitioning almost all of their commercial operations back to the highly recognizable World Fuel brand. This is a brilliant move. It immediately cuts through market confusion and unifies their global presence under a banner that their legacy customers already know and implicitly trust. Moving on to Section 2, let's dissect their three core business segments, where we'll see exactly how they are cutting fat and boosting those margins. So if you peel back the layers, you literally see a tale of two trajectories. On one hand, you have explosive growth. The aviation segment's gross profit jumped 20%, heavily driven by their smart acquisition of Universal Weather and Aviation's trip support services. Meanwhile, marine gross profit almost doubled, up an astonishing 86%. But then you look at the land segment, and gross profit actually declined by 16%. Now, before you start ringing the alarm bells, you need to understand that this decline is highly deliberate. That land segment decline, it's all about physical distribution infrastructure that they are purposefully shedding. Management calls these non-core divestitures, but really, they are just getting rid of less profitable, highly complex physical assets. They are quite literally cutting the fat to improve overall returns, which explains exactly why we saw total corporate margins widening so dramatically earlier, even when overall revenue was essentially flat. Which brings us to Section 3, the energy transition pivot, going way beyond traditional fuel. The absolute cornerstone of this whole forward-looking strategy is SAF, or Sustainable Aviation Fuel. As strict global decarbonization mandates, like the tightening CORSIA rules, come into full effect, SAF is rapidly transitioning from some niche, feel-good environmental initiative into a hard commercial imperative. And because World Kinect has a dominant presence across over 8,000 aviation locations, they are perfectly positioned to be the prime distributor of this high-margin, lower-carbon alternative to airlines across the globe. To put this in perspective, just look at how this builds across their strategic timeline. Back in 2023, they changed the corporate name to World Kinect to signal this broader energy focus. By 2025, they proved their immense scale by blowing past $53 billion in annual revenues. And now, in 2026, they are aggressively scaling Kinect Online. This is their digital suite offering end-to-end carbon tracking, renewable energy brokerage, and sustainability advisory services. They aren't just a delivery service anymore. They are delivering pure energy intelligence. All right, Section 4, navigating the competitive landscape and building that moat. Let's be clear, they are not operating in a vacuum here. They are getting squeezed from multiple angles. At the top of the food chain, you've got the integrated oil majors, your Shells and your BPs, who have massive upstream refining advantages and can absolutely undercut them on price. Then you have regional specialists, like Bunker Holding in marine, aggressively expanding their physical footprints. And finally, at the bottom, there's a whole new wave of nimble, digital-first startups offering automated fuel management platforms that threaten to completely disrupt the traditional service layer. But don't count them out, because World Kinect's competitive moat is actually formidable. Their physical logistics scale is wild, spanning over 70 countries with more than 3,000 delivery sites. That massive global footprint is exactly what buffers their clients against localized supply shocks. But the real magic? It's how they bundle that physical delivery with their Connect online digital platform, plus customized financial hedging and credit tools. By acting as a financial risk manager and a compliance advisor, rather than just a guy selling a commodity, they make their corporate clients extremely sticky. In fact, clients adopting their integrated platforms see retention rates of 60 to 70%, which is double that of your standard fuel supplier. Let's bring it back to the raw numbers. In Section 5, Financial Health and Ratios. Looking at the ledger. Okay, let's look at the actual valuation metrics. We've got a very reasonable forward PE of 12.62 and a price-to-book ratio of 1.35. But what really catches the eye here is their highly competitive debt-to-equity ratio of just 0.65. When you consider the industry average hovers way up around 1.2, World Kinect's balance sheet is incredibly healthy and underleveraged. That gives them huge flexibility to invest in new technologies. Add to that a solid 2.52% dividend yield, and you are looking at a very attractive profile. And management definitely knows how to keep shareholders happy. Just look at this, over $126 million returned to investors. In this first quarter alone, they executed $75 million in common stock repurchases, on top of paying out steady dividends. They are actively, aggressively rewarding shareholders while simultaneously navigating a massive corporate restructuring. All of this, the strong Q1 liquidity, the wider profit margins, the deliberate portfolio simplifications, it gave management the confidence to take a pretty bold step. They raised their full-year 2026 adjusted EPS guidance to an impressive range of $2.65 to $2.85 per share, up significantly from their prior estimates. Finally, Section 6, Strengths and Strategic Risks, the bottom line. Now, I want to be perfectly clear, it is definitely not all clear skies ahead for World Kinect. They face immense, constant pressure from volatile global commodity markets and geopolitical supply disruptions. In regions like the Asia-Pacific, they're actively battling aggressive, locally integrated, state-owned competitors. Furthermore, despite that high net income we talked about, you have to note that their Q1 free cash flow actually swung into negative territory by $60,200,000. That's a sharp drop from the $99 million in positive cash flow they had last year, driven almost entirely by the intense working capital requirements of running this kind of global operation. So here is the ultimate balancing act for the company. In the short term, yeah, they are absolutely reliant on the high-volume revenue generated by traditional fossil fuel distribution. But their long-term viability completely depends on making massive, capital-intensive investments today. Investments into sustainable aviation fuel, green hydrogen, and digital carbon advisory services. They have to execute perfectly, essentially using the cash generated from a dying legacy business to build their green future. Which leaves us with one massive billion-dollar question to wrap up this explainer. Is World Kinect's bold transition into green energy and digital advisory actually moving fast enough? Can they leverage that huge 70-country footprint to secure total dominance, or will the weight of declining legacy fossil fuels drag them down before they ever reach the finish line? Keep a very close eye on their capital allocation in the coming quarters. It's going to hold the answer. Thanks so much for joining me to break this all down.